అడ్మిట్ చేస్తాం సార్, మీరు జాయిన్ అవ్వండి సార్.
అట్లాగే పోస్ట్ పోస్ట్ అవి వస్తున్నాయి చూడు యూట్యూబ్.
అంతేనా? ఇప్పుడు నేను మాట్లాడడానికి సౌకర్యంగా ఉంది ఇక్కడ. అంతేనా? వెల్కమ్ అటు చెప్పచ్చు. ఇట్లా ఒకసారి
ఏమి షట్ డౌన్ కాలేదు.
నాది ఉంది ఎండింగ్ వరకు ఉంది.
అదే
2 hours పైన ఉంది.
ఇప్పుడు కూడా ఉంది సార్ 2 hours వరకు.
మేడం రమ్మని చెప్పేసి
అసైన్మెంట్
సోషల్
కరెక్ట్ సార్.
ఉంది సార్ లైవ్ ఉంది సార్. ఏమో కనెక్ట్ అయ్యారా? ఎందుకంటే
మ్యూట్ లో డిస్కషన్స్ మ్యూట్ లో పెట్టారు.
यहाँ पे अभी नहीं करा।
Am I audible?
Good afternoon, sir.
Good afternoon, ma'am.
How are you, sir?
Good afternoon, sir.
Good afternoon, ma'am. Good afternoon. Oh, Madam Connector. Good afternoon, Madam.
Good afternoon, sir. Namaskar, sir.
Namaskar, namaskar, madam. Namaskar. Most welcome, Madam.
Thank you so much, sir. Thank you so much.
Madam Connector.
Good afternoon, madam.
Good afternoon, Dr. Shadashna.
Madam, host. ఇక్కడికి వచ్చి చూస్తాం. మీరు అని చూపించా మేడం దగ్గరికి వచ్చి అట్లా కాదు పోస్ట్
Are we good to start, sir?
Yes, sir.
Yes, madam.
Yes, welcome. Yes.
Good afternoon, everyone. I feel privileged to welcome you all on behalf of Sri Vidyaniketan Institute of Management to the second day of national level 5-day workshop on discerning behavioral finance and commodity derivatives. Yesterday, we had a great session by Dr. Shikta Singh on behavioral finance and hope that will continue in today's session. Before starting the session, I request our senior professor in the department, Professor N. Gurnan Naidu Garu, to share few words.
Thank you, Gaya Madam. I am very happy to connect with you all. Once again, welcome Dr. Shikta Singh Madam. We are extremely sorry. We are extremely sorry for yesterday's technical glitches.
No, sir, it is not none of your fault. These things happen.
Yeah.
I
So
do
it's all experience.
Option listen, madam.
Yeah, madam. So yesterday, I also apologize all the participants. Nearly 916 participants they are registered for this workshop, and I am extremely happy to share with you. Participants are from Philippines, Bangladesh, Sri Lanka, Nepal, and Saudi Arabia, and they are very eager to connect, eager to listen to Madam. And we have conducted many webinars. We have not experienced like this. Anyhow, it's all learning lessons. Madam, yesterday, whatever you have shared with us, many people they contacted that they have missed your lecture. What we did, we have shared your lecture in the WhatsApp group and requested all the participants to listen such that you will have connectivity for today's session, madam. This is what we did, and many of our participants they have already connected and they heard about your lecture, so that it will have a continuity. Once again, I welcome all the participants and participants from abroad, particularly from Sri Lanka, Nepal, Saudi Arabia. Some people are connected through YouTube link. I also welcome our colleagues in the department, students, and different participants across the country. Learning is a continuous process. We need to continuously, we must continuously learn. We have an excellent resource persons, two resource persons. They are like two eyes. They are going to open many things and they will make us to see a lot. So they are going to share us a lot of insights from behavioral finance and derivatives markets. We are extremely happy, madam, to listen to you. I am sure there will not be any technical glitches. The grace of Lord Balaji. And I welcome you, madam, once again. So now session is yours. Over to you, madam. Thank you very much.
Thank you so much, sir. Sir, you need not apologize for all these technical glitches that do happen. And I do understand, because this is something which we call it as an exogenous factor in our economics, as well as a part of our behavioral indicator, something which is beyond our control. As COVID happened, and it has created a surprising change in terms of businesses, in terms of health, in terms of education system, whatnot. So we have seen the economy being transiting from a phase, which we call it as in terms of S-shaped recovery, U-shaped, and rightly now as K-shaped growth. So we are seeing that those who have adapted to this change, they are having a increasing trending, and those who have been lagging in terms of that has shown a lag. So few sectors have increased like anything, and that has what has impacted positively upon our GDP count. That is how we can say that 20.1% when you're saying at the nominal rate of this quarter, this is because of this adaptation despite of these difficulties. So, sir, I am really, really thankful to, in fact, Sri Vidyaniketan University, your chairman, Dr. Mohan Rao, sir, Dr. Sudarshana, sir, who has been a really, really great person, and he has been helping in terms of and briefing me how to go about this, about how the participants, and it is a very huge response, I must say, 960. It's in fact a very good response which has come upon. And Professor Gurunatha Naidu, sir, it's really a great privilege to have you in connect with. So, and all the participants, I feel that this entire journey is a kind of interconnection between us and them. It is not that the other way around. That means the resource person is that there will be the speaking, they are knowing everything. I believe always in the pathway of two-way communication. It is always learning from the crowd, and every webinars or conferences or any kind of resources which I am delving into, I find the mutual learning which has happened. So thank you so much. Thank you so much for inviting me.
Thank you, sir, for sharing your valuable notes. Now I request Dr. Shikta Singh to continue this session, ma'am.
So as for these participants, those who are new to this, I mean, they have not been able to attend my yesterday's session, to just give a few of those glances about what we learned yesterday and what we have discussed yesterday. We have just come into the nuances of behavioral finance and how do those dimensions, naming few of them as your loss aversion or it is mental accounting, the herding effect, how do it creates an impact on an investor's decision making? Before we start, just let me allow to narrate one a very interesting incident which happened just a couple of days back. So we were having our HR conclave, and one of our guests, he was the CEO of a company, and I was moderating that session. And out of curiosity, I just asked him that, sir, that what are the factors which you tend to look into while you decide any level of investment? So initially he stated that, yes, I look into those macroeconomic factors like the changes in the cyclical movement, the structural changes or the cyclical changes. I factor in the econometric model. I factor in the various fundamental factors of a company. I look into those, the deviation in the exchange rate and the various rates changes, which is happening as far as the monetary cuts and monetary policy is concerned. So that created another inquisitive within me, which led me to ask him another question, that is it so? Is it so that only these factors are affecting your decision? He took a pause and then he stated that, okay, madam, let me come up with the truth with you. Then he shared that every day, early morning, while I take my, it was his statement, which I'm just quoting. So every morning while I woke up and I have my morning tea in my balcony, I see few number of birds which are sitting on the cable wires of the balcony. And if I found an odd number of bird, that day I will be very happy to go into the market. But in case, if I find an even number of birds sitting, I would be really reluctant to get into the market. So is there any connection between the number of birds which is sitting in his balcony along with the investment decisions? People will certainly laugh at it, but these are some of these behavioral components or behavioral indices which we are, maybe we are, our unconscious mind looks into that, but our rational brain does not allow us to think about that. So that is how the various impediments of, or the dimensions of behavioral finance. So what are the various factors that can be studied, and research ventures into these arenas? Because apart from that, the behavioral corporate finance, it discusses certain issues pertaining to the financial issues of dividends under the various factors of macroeconomic indicators, thereby imbibing the behavioral components. If we study the impact of valuation of a company, right? So in that sense, you will state that, okay, what is great about that? I will look into the various factors. I know these factors. Based upon these factors, I will decide either it is good or it is bad. But behavioral finance is something which has always been a positive approach, which I mean that where the behavioralists state that we always do what we want to do. What are the facts? What is actually existing? Unlike economic theory, they don't only go by the normative approach. That means what should be or what should be not. So there are multiple factors which are creeping in terms of certain anomalies, certain inefficiencies, which are affecting the market. And that is what has been the behavioral trend of the market imbibing the various fundamental factors. So post-lunch session. I hope this is, let me start with a very interesting video. And I hope many of you might be knowing him. But still then, what connection does it have with our session today? You can very well make it out.
The Coca-Cola bottle is 100 years old this year. Wow, that's even older than I am. I think that calls for a song. Well, let's go back to that key. Coca-Cola Tidbit Company. I think I'll move this just up a little bit. I like to teach the world to sing in perfect harmony. I like to buy the world a Coke and keep it company. Of course, I could buy the world a Coke, but I'm not sure my shareholders would go for that. Boy, that is the real thing.
So I hope this message and everybody could recognize who is he. Any responses? The financial market is not unknown about Warren Buffett, isn't it? And Warren Buffett, the greatest mistake which he feels in terms of buying the stock of Berkshire Hathaway. I hope this has been the classic case study in all of our classes. Am I audible? So in that sense, when we are talking about the valuation of a company, so does that valuation has any impact, or it is being created by the various behavioral dimensions which we spoke in the last session? Some of you may say yes, some of you may completely deny to incorporate those valuations. So the market has been seeing all kind of behavioral dimensions working into or factoring into the various models. And few of these dimensions are taken up as an indicator of the behavioral growth strategies. So going by today's session, which devotes to our anomalies, the role of anomalies and how do market anomalies plays a pivotal role in by creating an impact on those various investment decisions. And what are these anomalies and how do these anomalies create its impact, be it decisions related to an individual investor or be it an investors related to the institutional investors. How do anomalies work and what actually these anomalies are? So if we go into the few of these famous quotes by Kenneth, which states that a market is a combined behavior of thousands of people responding to information, misinformation, and whims. So the market is always responded to various amount of noise traders. So certain noises are created within, certain noises are created outside. So do this have an impact upon the share prices? It has been seen that there has been some extent to which the market has responded either positively or negatively to all this side of affairs. So therefore, we are going to reflect few of this. I'm not going to dig deeper into this financial model of EMH because that we have already discussed last. And But the most important thing which I'm going to present today is pertaining to the market inefficiencies which are disturbing the efficient market. And my various instances which has happened with the stock market anomalies, bubbles, crashes, and has deviated the market from its mean performance, thereby leading to an underperformance. So when we begin that, can we as an investor consistently beat the market? So beating the market is probably we are not having a godly kind of power. So it may surprise that the answer can be probably not. But we show that even professional money managers with trouble beating the market, at the end of the session, we can find out few of these amazing experiences which can be dealt with: January effect, Monday effect, the occurrence of turn of the month effect, turn of the year effect. So how do these impact the market whilst investor decision? So this ideology of behavioral finance intends to have an application of psychology to the various financial behavior. Here we are mentioning and here we are studying the behavior of the practitioner that are existing. And as per this discipline of behavioral finance, we have categorized the investors, even if they are rational, but there is not existent of any linearity of this rationality, because there is certain irrational exuberance which are in the form of various market drivers, thereby impacting the various cognitive biases, heuristics, emotional biases, and causing a deviation in the market. So due to this, we find the deviation in the asset value from that of their fundamental value and the basic fundamental theories which the market suffices with. Just going back to our traditional portfolio theory, which I hope everybody belonging to the finance domain has been aware of. So age-old, the standard finance model, which is considered with our portfolio model by Markowitz. And there, the many researchers has followed Markowitz's principle of stating the rational investors, those who create a portfolio, given a set of return, expectation, the volatilities, and the cross correlation. So the rational investor here is maximizing expected returns and minimizing the risk. That is why they work under a constraint, and the investor is pressured by the two opposing forces: the desire to make earnings and the dissatisfaction that are produced by the risk. So in this way, the risk and return that is always attributed as a key element of an investment strategy. So when we look into creating our mental accounting, yesterday I was mentioning about mental accounting, where we tend to divide our entire level of expenses onto the various portfolios. So that is also fundamentally backed by our level of risk-taking abilities. So in that order, selection of a portfolio, the model requires certain information. Number one, pertaining to that, what will be my expected return on the asset if I invest in portfolio X rather than that of Y? What is the standard deviation of each of this asset? These are the certain research questions which we take up while we undertake a research. What is the covariance between the returns of every pair of asset? So given this information, it is always possible to construct an efficient portfolio frontier where we follow the efficient market. And the portfolio is claimed to be efficient when it offers the highest return given a specific risk or minimizing risk with a specific return. That is what is proven, and Marquis' principle states about that. But consequently, the group of the efficient portfolio can be determined by solving any of this subject constant. So a bit into this econometric phenomenon where we can look into that how we maximize the expected return of a portfolio subject to a given portfolio risk. So here I have taken certain factors in terms of expected rate of returns, which is equivalent to the various independent variables in terms of on which it is depending upon. So all these things are the explored factors which are impacting my level of expected returns, and that is subjected to the level of profit. So either we are enabling ourselves to maximize the expected return of our portfolio, or we are trying to minimize the level of risk for a given portfolio in order to get a certain amount of return. So this is our basic econometric models which works. But how do the behavioral component disturbs this? So this is what is our standard practice. We follow a certain trend backed by our old theories, but we negate the various disturbances, and this disturbance can be an anomaly. So where we call it as an anomaly, which can disturb our so-called optimal portfolio of an investor. Where I believe that if I follow this, the rational investor, I may be able to get the highest possible risk, thereby lowering the, highest possible return, thereby lowering the risk. So this is my pretty much assumptions, which I am trying to consider by following this portfolio model. And it is a time-tested Marquis model of running out with the various diversification backed by our expected utility model. So in that sense, when we are trying to creep in the biases and the various investment decisions, so this is basically, it works into a various top-down approach of investment decision. So when we look into the various top-down approach, we look into the fundamentals and the macroeconomic factors. The fundamental factors which will venture into the company's record, the company's account in terms of its various performance. You have the PE ratio, you have the book value of a company, there are certain neglected shares. So these are some of these fundamental factors which are existing for the various companies. But apart from these fundamental factors, there are certain anomalies. So when we are calling these anomalies are nothing, but in plain and simple language, this refers to any form of inefficiencies which disturbs our regular market. So there can be n number of factors. We cannot say that prices always will take a random walk. So how do these anomalies affect our behavior? Here you can see few of these anomalies which has been mentioned as a cognitive biases. And Ritter, in his work, who is the professor in Florida, has come up with many of those cognitive biases and tried to inculcate and found out the presence of these biases, these anomalies, these have affected the investment decisions, be it in terms of the asset which we are leveraging to. So that is why this model somehow integrates our classical financial model, thereby involving the various cognitive evolution in terms of the heuristics, where we mentioned about the rule of the thumb principle. Many a time while discussing in our class, we also provide an example to the students that in what way that suppose you ask a student that a good stock is of a good company and is considered as a good investment. It is considered for good for investment. But does it always hold good? Let me cite you an instance of Nalco. If you look into the Nalco, which is a Maharatna aluminum company, and it is a PSU, public sector undertaking, there was some insiders information which was replicated in terms of the media response through Twitter and through CNBC regarding its privatization. So just imagine that what is the impact of a privatization or a media response, a news related to the privatization of the company. And today, the shares of Nalco, it has increased by 10%. So is it not sheerly due to the impact of a behavioral component, which has impacted the shares of Nalco? Yesterday, I hope all of you might have experienced, it was worldwide, WhatsApp, Facebook, they were down for more than 6 to 7 hours. So right at, I think if I look into the Indian Standard Time, after 9:30, the WhatsApp and the Facebook applications were down. Due to this, there was a loss of more than 10,000 crores to certain company. So again, don't you think that this would have created in terms of undervaluing the shares of Facebook and WhatsApp due to this? So all these outlying factors indicate the level of the encryptment or incubation of this behavioral component while we are making any form of analysis and taking up anomalies as a very pertinent factor in order to study this. So when we are particularly mentioning about the stock market, so here the stock market can be broadly categorized as calendar, fundamental, and technical anomalies. So however, literature studies apart from that will go by the various anomalies which are affecting the market in terms of these three categories of calendar, technical, and the fundamental anomalies. So EMH also, which is a very, very prominent theory, practiced financial market model, reflecting all information, considered to be the most efficient market. But still then, there has been many precedences of research which has shown that EMH has not been functional properly. And that is why we cannot say that beating the market is always and it is completely possible. So beating the market, when you are saying, that means the market is consistently growing. It is consistently earning a positive excess return. So this is one of the strengths when you are having your excess return on an investment and the return is in excess of the earned amount by the other investment, thereby possessing the same amount of risk. So again, looking into this news which has come up rightly on 24th of September in this week back, surprisingly very interesting, you will see that the Sensex have shown a rising indicator across all the benchmark indicators of its peer groups, be it Dow Jones, be it Nikkei, be it FTSE, be it Shanghai. So what is the reason about the rising or the mounting Sensex, which has outperformed all its peers? And on top of that, you will also find that more number of individual investors, they have seen their numbers have spiked up as far as their investment in the share market is concerned. That has been also one of the prime reason for indicating a positive index into our Sensex from financial year 16 to financial year, which is estimated 2022, you can see the rising numbers of the individual investors as well as the FIIs, which is happening in India. So this creates a very, very positive index. And here the market grows and the mindset of the investors to invest has taken a positive 10. The psychology of the investors, it has been more oriented towards market, which has created a positive turn as far as the various indices are concerned. So that is why when we are talking about, and we are consistently talking about certain forces that can lead the market to be efficient. And why it is so? The reason being, the investors use their information in a very, very rational manner. I will say that I will go into a set pattern. I have all the information, either it is overvalue or undervalue of financial aids. So if every investor always makes perfectly rational investment, then it would be very difficult to earn an excess return, isn't it? But does that always happen? Or is it possible that all the investors always they make perfectly rational investment decision? So there are certain independent deviation from the rationality. So if you consider the market also have many investors, those who are considered to be irrational. I'm not mentioning about irrational in terms of losing out of common sense, but here irrational refers to all those behavioral indicators which makes the investor not completely rational, but also consider it to be a human being. Because as a human being, we cannot expect ourselves to perform like machine. We are bound to make errors. So that is why here the investors has been termed as irrational. And the net effect might be that each of these investors can cancel out. How they are canceling out? For example, when we are going into an inefficient market, there are certain noise traders. I hope all of you know that the noise traders who create a consistent noise. There are certain insiders information, where if the information leaks, as I suggested about the case of NALCO, where the information leaks regarding this privatization issues, it will surely impact the shares of NALCO. So these noise traders, if I go by our traditional financial model, which calls for market equilibrium, but market, if we see it never ever, it is possible that always it will resolute at an equilibrium position. There is always a deviation. So the traditional state of mind will call for a market to be equilibrium, but the arbitrators, those who work on the fundamentals, this will tend to create a opposite sense of view where they will try not to balance out. So the noise traders, what they will do, they will tend to pull up the prices, but the arbitrators will try to pull down. So there will be a neutralized effect between the two. So ultimately what you will see, if you look the market, if at all it is balancing out or if it is neutralizing, then that is because of this friction which is created between the arbitrators and the noise traders which are working in the market. And apart from that, that is why it is called that there is always a limit which has been set to the arbitrators. And these are also affected by the various animal spirits, which are basically the factor of greed, the factor of fear, the factor of anxiety to lose out in the market. That is the reason why loss, that is your loss aversion, has been taken up a very, very fundamental criteria for dealing with the market. And these are some of the inefficiencies or some of the factors which you can term it as inefficient market, inefficient factors, which can disturb an efficient market. So slowly and slowly, research is being venturing into to find out what is the role of these inefficient factors into a efficient operation of the market. So technically, if you look into this EMS, we have these three sets of market which operates in the weak form, in the semi-strong form, and in the strength form. But still then, even if you can say that you have wide range of information with you, but still then the biases, in fact, knowing everything, which is an hindsight bias, can make you or can lead you to make mistake. Sometimes knowing everything is not the right way to conduct efficiently in a market. That is why we have been stressing here on the various sets of anomalies, and these anomalies or these market anomalies are nothing but these are some kind of inefficient factors, some kind of disturbance factors which tend to make an efficient market to be inefficient. Let me take some of these implications of this model about how this is working. So if you look into the research, there has been certain sophisticated techniques to test whether the past stock price movement that help future stock price movement or not. But always this past tracing, following a past trend or looking into an anchoring phenomenon does not work forever. So that is the reason why nowcasting model has been very, very efficient in terms of determining and predicting forecasting. That is why economists rightly follows a nowcasting approach of determining the factors, not the forecasting approach, because again, the forecasting approach is going well with certain lag effects. The lag effects are more in the forecasting model. So rightly nowcasting models have been more appropriate, more valid in terms of finding out those current returns and thereby to predict the future. So this is how there has been a transition, and thereby we are trying to bridge the gap through our various models of the studying of these approaches in various anomalies. Let me show you one of these instances about how the new information, it gets into the stock prices. So for instance, if it is in a semi-strong form, the EMH, where we stated that certain amount of information is publicly available, and the stock market, they tend to find out the traders that they buy and sell based upon their views of the future market prospects. But it may happen that the future prospects for the stocks are influenced by some unexpected news announcement. In terms of, let me cite another important market anomaly, which is considered as the PEA drift, the post-earning announcement drift. You might have known, and you have also might have experienced, those who are traders, that usually any form of bad news, the companies, they tend to announce usually at the weekend or the last days of the week. The reason is, since Saturdays and Sundays market are closed, so even if that is a negative news and it affects badly on the stocks, the stock prices will go down in Saturdays and Sundays. Monday will be a bit low, and again it will recover. So that is what is a kind of post-announcement. So any kind of positive news, they are usually not announced in the last working days of the week, but negative news knowingly they do so in order to find out the market reaction. So that is why this sort of efficiency in the market, they are somewhat adjusted by the new information. Either it can be in the form of a reaction which is creating, some can be a fast reaction because we are responding differently to the various amount of news. And we are making a validity check that what is the source of that news? Either it is a reliable source or it is not a reliable source. So based upon that, any form of news, any form of media response creates an impact in terms of shooting up or shooting down the prices of the stocks. And that is the reason how the price over adjusts to new information, but they eventually falls to the appropriate price. And that is the reason you can see that how new information gets into the stock prices, thereby causing for the days relative to the news announcement. You can find the market reacting in different way. There can be overreaction, there can be underreaction, there can be delayed reaction. So these are nothing but these are called as a deviation from our market efficiency. And that is what is the role of anomalies, which is affecting the market in terms of various responses. So while capturing the data, while capturing the analysis, if the questions of the research questions are projected in a varied form rather than that of the typical sense of traditional question in terms of getting into the behavior of stock market, one can look into the nuances of finding out the efficacies of all these factors, that how all these factors have an impact on the stock market or any other market, looking into these indicators. So in this case, the researchers may have examined the effect of many types of news announcement, and this can have an impact on creating an adjustment process within itself, or it can create the size of the stock market reaction to the news announcement. And that is the reason the test of many of these hypotheses can be called up with a certain event study. Yes, ma'am, I saw a hand being raised up. Yeah, any question? Hello? Dr. Sudarshana, is there any question? I would love to take up if there is any question to further.
Madam, no questions, madam.
I saw a hand raised up, so that is all. Okay, sir.
There is something. No questions.
Let me cite you another interesting case of a medical company and how was this affected the prices due to the invasion of one of these behavioral environments. So in this case, this was a case of an executive of an advanced medical optics care eye, and it is recalled as a contact lens solution called as the complete moisture plus multi-plus purpose solution. So the advanced medical optics, what they do, they took into this voluntary action after the Centers for the Disease Control and the Prevention, and that they found that there is a link between the solution and a rare cornea infection. And the medical name which they have come up for this cornea infection was the Acanthamoeba keratitis. And the event was studied as the cornea infection in the name of AK. So the eye executive, it chose to recall the products even though there was no evidence which was found that there is manufacturing processes which were introduced. So the parasite that can lead to the AK. So therefore, the company officials, they believe that the occurrences of AK were most likely to result of the end users who failed to follow the safe procedures when they were installing the contact lenses. And because of this reason, the iShares, which opened up at 34.37 because of a kind of bad news which entered into the market regarding its quality of lenses, it completely slipped the shares from 34.37 to 5.83 from the Friday, the closing with. So that is how it showed an impact of a behavioral change into its company's shares. And that is how I had tried to plot it in the form of a scatter plot, where you can see that how this kind of impact it has created in terms of a downsizing of these prices later on. So what I was mainly trying to state that when we look into the various kind of information, it is not only in India, if you look into advanced countries in US also, how this information are traded off, how we are trading off with those information. I'm not encouraging this biases to operate, but what I am encouraging is realization of this biases. Once we, as a trader or one who is a marketer, if we are aware of this inclusion of these biases, then we can pretty much state that to what extent we can take the interference of these biases into our work, into our lives. So the market, either it is stock market or in US dealing with the journalistic walls. So each of them, they have a certain amount of biases which are performing either in the form of informed, or it is considered as a legal insider, or it is someone who is not at all an insider trading, but it is illegal. So some informed traders, which we are known to be an insider trader, but when you hear the term insider trader, you would likely to think that such activities are illegal. But that doesn't mean that all insider traders are illegal. There are companies insiders that can make perfectly legal traders in the stock of their own companies. And they tend to comply with the reporting rules by the SEC. And that is what is reported in terms of our SEC and in our case with our SEBIs. So how do we respond to this information? That is how that impacts the prices of our shares. So who is an insider? As far as our fundamentals go by, we are talking about an insider, someone who has some kind of information which is not publicly available. But again, to what extent is this information reliable? That is why we go for a confirmatory test analysis to find out this information. And that's the main reason why in few of these universities, you'll find those who are starting behavioral finance at the course, you'll find certain behavioral finance labs are operating where they find there is the working of fMRIs, they are tracing out the eyeball movement of the stockist, and through that, they are able to find out that how is this acting as a factor which can be a main determinant of carrying out an investment rather than that of the usual or the official practice. So in that sense, I'm not going into the further technicalities of that, but that is how basically the person, because when we are dealing as a passive investor, we have to carry out our decisions and keep track of this insiders information which are being floating in the market. And that is the reason how the herding effects or the overconfidence biases or optimism biases that do have an effect in terms of the market. There are many cases pertaining to this, and in the past as well as in the present, where it has shown that how is all these biases, they have impacted the, I hope many of you have been also been aware about the Implom company, which was a very, very famous caselet. And usually in our finance classes also, we take up these cases while doing with our finance valuation chapters. So ultimately, if I will say that, are the financial markets efficient? The answer might not be. If I look into, or if I trigger into the various behavioral components, I would rather say that the financial markets are not completely efficient. Why they are not completely efficient? Because there are certain amount of inefficiencies which trigger into the market. Either it is created through the various noises, either it is created through the various informations, the news announcement, the kind of risk adjustment factor, the various operation of anomalies which work. So that is why we cannot always state that the markets are always behaving in an efficient market. And that is also not quite obvious to state that efficiency will work or efficiency will match up to its limit as far as this market goes. There were a few more cases. I'm not going into this. So let me come into a few of these anomalies more. So we will take a few anomalies which are operating. You'll find some of these anomalies are permanent in nature. They are there, and they, in some ways, they will be there, but some kind of fleeting anomalies also do operate. So these fleeting anomalies are nothing, but they will tend to disappear at some point of time. But there are certain anomalies which are used as a trading strategy. Knowingly, the market has seen that knowingly such anomalies are used in order to act it as for their favor. So that is why there has been different kinds of market anomalies which has created a gradatory change into the market. So when there is any form of abnormality which is operating in a smooth functioning market, and this come up as an indicator and they disturb our efficiency market, that is why we can term them as our market anomalies. And therefore, very well mentioned by Kahn and Tversky, where they have caused anomaly as a deviation from the presently accepted paradigm, which is too widespread to be ignored, too systematic to be dismissed as a random error, and too fundamental to be accommodated by the relaxing the normative system. So as I mentioned, behavioral finance is a work of not what should be, but rather it is a work of a positive sense. That is what are the facts, what is actually happening. So that is why the behavioral finance has always been posed as a non-normative approach rather than that of a normative approach. I have one of my work based upon this calendar anomalies. I will be sharing this work with you once the session is over, and you can have a look about how the calendar anomalies are affecting in terms of deciding an investor's behavior. So going by a few of these calendar anomalies, these have been some of these anomalies which has found its efficacies in terms of its functioning, and we call it as, one is Monday effect. So Monday effect, what does this Monday effect mean? Monday effect or a weekend effect, alternatively, also it has been called as. Here, if you can look into the prices of the stocks, you can see that the negative prices has come up. There has been a clear indicator of the negative prices, which has impacted the calling for this price in the companies for this. So the reason can be because of the post-earning announcement drift. And there can be other factors which are internal, which has called down or which has pushed down the prices of the stocks, particularly when the market opens on Monday. So in this sense, when we describe the weekend effect, it's nothing but it is a tendency of the stock prices to decrease on the Mondays, which means that particularly that the closing prices of Mondays are lower than the closing prices of the previous Friday. And for some unknown reason, the returns on Monday would have been consistently lower than the other days of the week. So that is why, in fact, the Monday is the only weekday of all the days where you will find that there will be a negative return in your stocks. So if such kind of trends are seen, then that can be stated as the effect of a calendar anomaly. That means Monday effect has an impact on the trading stocks of that company. And from that name only, the Monday effect was coined out. So this is how the behavior of the market anomalies can be seen, where you can find out the stocks opening at a high on Friday, on previous Friday of that week, and you will find that the coming up month in day Monday will be caused by a negativity surrounding. Usually many companies has particularly seen that when Mondays being the first working of the day, the people are really not adjusting to the working circumstances. After a long hours of operating in the work from home mode, particularly if you look into the IT professionals and those who are residing in metros, they have created a lot of use and agitation for not joining back office. Is anyone familiar with this? Why is it so? Why is so much of use and reaction for joining back to office? Because I think from home, the amount of work which is being done, it has surpassed the numbers and the amount whichever one who had been doing in their regular work office. I hope everybody would agree with me. If you want to disagree, you can equally welcome for that. But why is that? Many of them, they're reluctant to join back, particularly in metros. In metros, the travel hours, those who are traveling in local train, it was consuming 2 to 3 hours of journey. Again, that comfort which you have got in working from home, you have created your own workstation, and that has also enhanced your level of productivity. If I also look into my journey, I would certainly say that the level of productivity which was earlier, it has enhanced like anything, because I could explore into new model, new research, new ideas into my work. So that kind of change, IT technician, they have gone for salary hikes. Infosys, Deloitte, they are now going for salary hikes with less work. So is it not a kind of effect, if you can look into this kind of anomalies which is being described operating in the market, this has a positive impact in terms of studying as a factor while deciding any form of investment criteria. The similar to that is another one which is called as the amazing January effect, or the January effect, where you saw that January's and particularly other men, they have shown a positive indication in terms of their rising stocks. So the turn of the month effect, where you saw the tendency of the stock prices to rise in January, in comparison to other months of the year. So if such a pattern is followed by the companies that they have found out the influence of January effect, which is a calendar, again, it is a calendar anomaly, which has created a change in the stock market. So what do we see? That when we look at the returns, particularly when it is a one of small cap or as a large cap, it was seen that the January's average returns were relatively more than that of others. So it had created a positive indicator of rising of the. So I'm not saying that this is one which is existing. It may differ from companies, it may differ from places to places. But the thing is that when this is how one can inculcate this areas of research into their old research models to find out a difference of how do one can deeply explore the other possibilities which also do have an functioning or an effect into its behavior. So that is what certain existing, these are some of the existing calendar anomalies, but that doesn't mean that these are continuing. Yes, some of them are continuing, but some of them are also likely to be missed out. They have continued, but after that, past trends have not seen its continuum. So there has been turn of the year effect, where we found that the turn of the effect described a pattern of increased trading volume and higher stock prices, particularly in the last week of December and the first 2 weeks of January. So the last week of the daily returns in a calendar year and the first 2 weeks of the daily returns in the next calendar year, that were showing a positive trend rather than that of the rest of the days of that particular year. And that is what was considered as the turn of the year effect, where you can see positive changes in terms of the first few years rather than that of the following next years, where the mean difference of the market has been significantly lowered out at the verging end of the years. And this is how the analysis was carried out in order to find out the turn of the year effect, which is again a calendar anomaly as far as impacting the market. So the researchers have gone out of the way in order to find out the impact of all this thing. Either you call it as the turn of the year, either you call it the turn of the month, either you call it as January effect or turn of the month effect. And interesting was to find out the holiday effect. So the holiday effect was what particularly during the pre-holiday or the post-holiday of a calendar, the stock market was seen to gain on the final day trade before the public holiday. So that created lag effect. So the holiday effect can be attributed due to the expectations that there will be volatility at certain times. And if that volatility falls within that holiday, that can be self-adjusted and traders can make buy or sell around that same historical anomaly. And that is what they traded it as a holiday effect. So different kinds of anomalies are seen in terms of the various calendar anomalies, where one can very well find out the implication or the influence of Monday effect, the influence of turn of the year effect, the influence of turn of the day effect, turn of the month effect, holiday effect, post-earning drift, that is your PEA announcement drift effect, in order to find out that how do all these anomalies, do these anomalies have an impact or they don't have any impact. So this can be made as an hypothesis of various listing companies in order to find out and to what extent will they work. That is what can be the findings of our work. So a very pertinent question also might be coming into the mind of various researchers, those who are present over here, that why do the calendar effects occur? Is there any reason? And this name has been only associated because of their behavior in certain months of the year or certain days of the year. Based upon their performance only, they has been named like this. So it has nothing to do with a Monday or a Tuesday or a Friday. It is only because of their performance during that particular day of the month or that particular month of the year. So that is how universally that has created a tone in terms of naming it as a calendar anomalies. And this has been attributed, if you look into the January effect in advanced countries like US, it has been sheerly attributed to the, because in US, the tax calendar year is considered to be in December, and the investors, they sell off their stocks at the end of the year, and they tend to enter the cash in gains, and they sell the losing stocks in order to offset the gains for the tax purposes. That is one of the strategy which is being used. So once the new year begins, again, there is a rush back into the market. And particularly if you look into the small stock companies, that shows a rising performance, particularly during these days. And that spikes up their shares, particularly during January. And that is why it is called as the January effect. So as I stated earlier, that always a positive earnings that can create a upward price drift in terms of the behavior of the stocks, and a negative earnings that can create a downturn drift into the prices of the stock. And PEA drift has been a very, very effective way of dealing with this anomalies behavior. Let me cite a case recently which has happened with Uber. So how Uber actually had managed the anomalies in terms of its machine learning models. So this is a very, very recent news which has happened just day before yesterday, very early, in terms of that depending purely on the past events, it is always not enough or anymore for anomaly detection due to the dawn of COVID. So as every day, it seems that there is an anomaly, because you never know. We always say that change is the only constant. So as things keeps on changing, you will find anomalies creeping on into the market. So earlier, Uber said that it would contribute 3% of its drivers' earning into the pension plans. But while the drivers can choose to contribute a minimum of 5% of their qualifying earning. So the AI models, they acted as a very pretty much good as the data that are fed with. But what if the data that is being fed is no more of any use, or it becomes irrelevant? So in that sense, what kind of result can one expect when there is not a single anomaly in the data or inefficiency in the data set, but the entire data set can turn out to be completely anomalous? So that's exactly what the data scientists have been struggling with since the onset of COVID-19. And Uber was one of those most efficient in terms of dealing with this. It tried to look into the factors. It was faced with a similar problem with hundreds of terabytes of its historical data. They suddenly started adding no value into the anomaly detection. And Uber then decided to adopt the recency bias, which is operating in the machine learning model. So if one look into the last year, then yes, one can say that it looks really, really inefficient with the occupancies of anomalous. But one can look at the time of that window frame, and also if they follow a technical average model going by the moving average, that can be based on what you see in the recent past. That is why when we talk about the recency bias, that is based upon how you have been performing recently in the past. So that is what the recency bias is. We look at the most recent data, and it is not really an anomaly. It is recency bias is a cognitive kind of dimensions. So considering this into the direction in which the trend is moving, these models can catch up into certain level of variation. And it has a recency bias to look at most recent data, and that has given weightage to recent average than something that which has happened a few months ago. And that is why right now Uber does not follow a centralized anomaly detection framework. Instead, what it do, it looks at the various anomalies which are creeping into the market, and on a use case to case basis, sometimes the problem may not require with a sophisticated model. Sometimes they tend to deviate from these anomalies, referring to their Z score. In statistics, we follow F test, T test, Z state. So looking into the deviation, one of these examples of statistic model, which is historical moving average, that is what again Uber has gone for to work in its modeling approach. So what I'm trying to say that the knowledge of these anomalies are required in order to find out that to what extent they can be included for good, or to what extent I cannot say that it is in our control. These are also something which are completely beyond our control. So therefore, the operation of calendar anomalies have seen a lot in terms of its impact as far as this functioning is concerned. Let me share the article which I was mentioning about you. So this was a study which was done in order to find out the implication of various calendar anomalies into the market and how do they work, how do they perform. The objective was to find out that the presence of calendar anomalies in terms of the various stock indices before the recession and after recession, taking into the various behavioral dimension into consideration. And for that, certain literature work, these are some of the literature studies which were done earlier, which has shown the occurrence of few of these anomalies. But the kind of indices we had used in my work was what is the impact of this, particularly in the Indian stock market with respect to the IT and the banking index. So we tried to study the attempts to examine the calendar anomalies in the information technology and banking industry in India. And we tend to analyze the impact of Indian stock market conditions, thereby studying its persistence movement as far as the returns and volatility were concerned. So basically this was used for a secondary as well as a primary, and we have used the GARCH, T-GARCH and E-GARCH model fitting into a OLS regression. And prior to the study, this was the period which was used. And for that, going by a basic econometric model, try to trigger in these indicators of calendar anomalies, and ultimately found the impact. We have taken the variables D1, D2 as our impacting these various indicators of determining its impact on these two indices of IT as well as in BankX, taking up as D1, D2, D3, and D4. And we show that how the Garch model taking up these equations where the return has operated taking up as conditional variance with respect to the time period T, and ultimately within EGARCH and TGARCH to find out the overexploration of its leverage effect, tend to ultimately found that ultimately the find out the banking's returns over the year, they had a more volatile with respect to the IT returns. So that was indicated with a p-value. BankX had more kind of variability rather than that of P, and there was the impact of turn of the month effect that has shown a positive statistical significance with the bank returns rather than that of the January and the Monday effect. So overall, the turn of the month effect was found to be really, really impactful, and it was created as a seasonal indicator for the BankX rather than that of your IT index. So this was one of those study. I will share the paper with you. If interested, you can please go through it. So ultimately, what I'm trying to close up my talk or my session, that it is not that we can only factor in to certain indices or certain factors which are considered as the leading factors of a model, but always one should try to explore the various behavioral indicators or the behavioral components which are also having a greater impact in terms of deciding or in terms of leading towards the various forms of asset market which we are dealing with. And that is what is called as the behavioral indicators of growth. Thank you so much. If any questions.
I request participants to raise their questions.
May I know that how many the participants, how many of them this work they have done, or they have some kind of earlier experience in this work or in this area, or they are exploring into this area? Anyone? Or this is completely in some. I hope many of this our professors, those are present.
Ma'am, actually, this is Abhijit Karoy. Actually,
Yes.
ma'am, I am working in the area of time varying efficiency, that is adaptive market approach.
Okay. Yes, sir.
Actually, ma'am, I want to explore the time varying element of efficiency, whether there is any element or the market friction or market ecology can affect the efficiency. Actually, I want to know this particular area, and this is my area of research. Still now, I am working on this area.
Okay, okay. Nice, sir. So you are trying to find out what is the relevance of time, means looking into
yes,
conditions of various pre and post test analysis kind of thing.
Yes, ma'am. Actually, I want to know whether there is any market specific information or the market frictions, like any major changes like your COVID-19 pandemic.
So that is what I was talking about very recent about the anomalies.
Yes,
when you're talking about any change or any deviation, this is sheerly created by the anomalies. Either you put it
yes,
as in terms of your fundamental anomaly. For example, let's take your book value. If it changes, a book to price or your size, basically in financial anomalies, we go by the growth, that is your size anomalies. Usually it has shown that companies which are small sizes, they have turned to be outperforming rather than that of your large caps. So again, there is no consistency of the fact that always it might hold good, or there can be a deviation in terms of the low price to earning ratio. Usually it has been found that the stocks with low price to the earning share, they are likely to generate more returns and they tend to outperform rather than that of the market, while the stocks which are having high price to the earning ratios, it may happen that they underperform. Again, it is a kind of anomalies which do perform. So the low price to book value or the high dividend yield, these are some of our fundamental anomalies. And when you see any kind of deviation which happens to our usual market, that is what is the interference or the disturbance of these anomalies affecting the market.
Yes, ma'am.
Any other questions from the participants?
Hello.
Yes,
This is
yes,
Professor Ramanaya from Amity University, Madam, Haryana.
Yes, sir. Yes, sir. Professor Ramana. Yes, sir.
So good evening, Madam.
Good evening, sir.
So is there any possibility that market be efficient?
So we are always presuming and we are starting with this assumption that market is efficient. Market is always efficient because the efficient market always follows a set kind of model, which has been pretexted by
Efficient
our
market should reflect the all available relevant information into prices. Can you say Indian markets are efficient?
I would not favor that Indian market are completely sorry, I was muted. So I would not say that Indian market is completely efficient because we see a lot of inefficiencies which has also crept into the Indian market. So even if we start with an assumption that yes, market is efficient, market reflects all informations, which I stated in all the three forms, but still then inefficiency, there has been lot of cases and right now also, which you see that any kind of information which is passing on, that can create a disturbance into the market and that create an inefficiency. So a true efficient market is very rarely going by the recent dimensions of behavioral finance. I would subsequently not say that 100% efficient market do work in reality. So you may have your own views. You have all rights because this is what is a kind of matter of agreement and disagreement all about. We can of course go ahead with that.
Hello.
Yes, sir. Yes, sir. Yes, Professor Adil.
Yes, thank you, ma'am, for your wonderful, new insight. And I have been a market professional and have been into market from last 10 to 12 years. And whatever you said, it all had happened in form of, we call it gap down opening, gap up opening, and a lot of corporate restructuring do happen in a financial market from company side, and prices do incorporate all those things, where it is a next FPO or dividend or split, bonus, merger,
Exactly.
isn't it?
So that is what I didn't touch upon this corporate finance part because of this time. And since I was told many of these participants are also new to this arena, so I just come up with some of these basics. But yes, corporate finance is a huge gamut of areas which has seen in terms of agency conflict, in terms of valuation, in terms of mergers, acquisitions. There has been a lot of divergences where I have seen this inefficiencies creeping in. Yes, sir, your take.
Yeah, I'm coming to this research part. The moment we, take, regression analysis or various macroeconomic factor or micro or technical factor, and ultimately the time series which we are having for the prices, they are hiding so many internal information, isn't it? And only we are apparently seeing the price versus time chart, and a lot of disturbance and a lot of hidden gamut of things are hidden in it. How while doing a research, we take care of all those things, whatever our finding in terms of prediction or forecasting for future is coming, how far it can be accurate. And another thing I would like to add, apart from these econometrics model where we try to capture best possible way by incorporating various latest model, recently I have seen certain literature where people are doing research in conjunction with the machine learning also in order to capture more accurately.
Exactly, sir. So means recently also you will see that lot of factors, they are being done with the machine learning and all that. I'm not completely negating this fact. It is happening. It is bound to happening. In fact, one of this very famous case, I'm forgetting about the Suleimani case. I hope you have been aware of, sir.
Related with which company?
In terms of the Suleimani, as far as the just give me a second.
Okay.
It was related to the quants trading.
Okay.
So for quants trading, many of the companies has been following this set pattern. They have a proposition that even if we are following this this model of having this approach that we follow the AI and algorithmic, but again this algorithmic pattern has been deviated. So data science and the quantitative research modeling, they have actually failed to factor in the investment behavior and the response to the event due to the COVID pandemic. Just in Middle East, due to the killing of Iranian General Qasem Soleimani by the America in the Baghdad airport. I hope you have been aware of this incident.
Yeah,
The case
very much.
of Soleimani killing, what happened? The crude oil surged by 4%. And the US and Germany treasury yield, they nosedived, and the US stock market indices, they were up. And it was a knee-jerk reaction. The market had a very high response to that. But in the absence of any such even factor into the model used by the quant traders, their investors themselves, they lost the wealth. And similar was the fate of most of the quant fund managers. So when we say that when most of them had to lose wealth in the aftermath of COVID pandemic outbreak, so was it not that can we find quantitative trading factor in the behavioral biases? It happened recently. In that case, it was seen that how this has affected in terms of gearing up the prices. So despite of the fact that we can say that yes, many companies have been following AI or ML or algorithmic trading pattern, but again, we cannot negate this component of this dimension, which has also been building upon the stock company. You may also take up the example of suppose that that spot that volume spikes on Apple stock. Again, they have also followed a very quickly move. So if you build up a program which looks for this pattern across the Apple's entire market history, it was found that the pattern has resulted in a move upward 95% of the time in the past. So if your model predicts that it is say 95% probability, then that similar pattern will also follow in the future, isn't it? But again, in the meantime, if some kind of discrepancies happen because of the clash which is happening in terms of the manufacturing house in China, if some disturbance happen in terms of this manufacturing, can we take 95% based upon our past predictability for Apple to continue in the future? So that is what is backed by AI and ML, which forecast. But again, what I am trying to say that the power of attributes in the form of this behavioral change that can cause a change in the prices of the stock.
Thank you, ma'am. Thank you for wonderful explanation. And ma'am, do share your paper with us so that we can go in detail and can understand more research aspect.
I'm just
And
putting it in the chat box only.
okay. And ma'am, any recent research on this? I mean, the margin which most of the time these financial market employ on various market, that is VAR and ELM, value at risk and extreme loss margin, and in conjunction with the implied volatility. How I mean both function out. How I mean risk analysis these financial company
Yes,
do.
again, for this risk analysis, you will find different approaches to it. This risk analysis is also borne by our expected utility model, accompanied by the portfolio model. So we have three approaches, and prospect theory of which is given by Daniel Kahneman, that complies a greater scale to this prospect theories, where we are trying either to fit into the zone of risk aversion, risk seeker, or the risk neutral approach. So that can be very well identified by following the prospect theory approach.
Thank you, ma'am. Thank you.
Thank you so much, sir, for.
Hello.
Yes, ma'am.
Madam, this is Ramya. I'm from Bangalore, working as assistant professor in the Anand Sagar College. So it was a very good lecture. So as even I'm also pursuing my PhD in behavioral finance. So it will be a great help if you can share some materials, good readings, where I can understand behavioral finance and apply.
Ma'am, you can be in touch with me in my.
I'm unable to find the chat box, so
I'm also unable to find the chat box. Maybe it is disabled.
Yeah.
I have my mail ID with Dr. Sudarshana, sir. So sir can pass on my mail ID. And I will be definitely means this are this papers and relevant papers which are related to the work. I can definitely share with you so that you can further proceed. My mail ID is just shiktasingh@ksom.ac.in. I think in the previous
Yeah.
I have last slide was that.
Okay. Thank you, ma'am.
Thank you so much. Thank you.
Hello, good evening to everyone. This is Professor D. Sudarshan Murthy from Sri Vidyaniketan Institute of Management. Shikta madam, you have given an effective lecture which may be useful not only for the students teaching community, especially for the researchers. That researchers approached you through by this app, Zoom meeting. They raised several questions. You have given very good answers and very good insights also. Sri Vidyaniketan is given this platform, but this platform utilized by many people with the help of you only, madam. Because your this behavioral finance topic is not there in this, there is no flavor. So very good flavor coming from your topic only, and your efficient delivering of lecture to each and everyone is very nice, madam. On behalf of Sri Vidyaniketan Institute, I am telling you thank you very much, and at the same time, myself, I am ever grateful to you. Thank you, madam, for spending your valuable time towards our institute, especially. Anyhow, we are all owed to you in some point of view. Anyhow, madam, once again, I thank you, madam.
I thank you so much, sir. Thank you so much. Thank you to your university for creating such a wonderful session. And I thank all the participants, particularly those who are any kind of mistake on my part. Do
Nothing, madam. The mistake happened yesterday
because you start to make
from my institute itself because of due to some technical problems. That mistake was happened in previous day, so that rectified today itself. So that was the mistake happened. From your side, everything is nice. And especially your explanation with regarding the behavioral finance to understand is very nice. And mental accounting, each and every person psychologically they can spend the money. And this efficiency of the market also today explained in a good manner, and each and every person can understand about your lecture, madam. So your insights today is most valuable. So that I can say, not only for the students, faculty, especially to the research scholars. Once again, I thank you on behalf of Sri Vidyaniketan Institute, madam.
Thank you, sir. Thank you so much. I wish you all the best and your institution. Do visit to our institution, all of you also, and be associated with us also in the future. Thank you so much. Thank you.
Thank you. Thank you, madam.
Thank you, sir. Thank you. Thank you all.
Thank you.
I will share the feedback link. I will share
There is
the
a
feedback
feedback. So we request all the participants to fill the feedback form, which will be shared in WhatsApp group. Thank you.
Okay, sir.
Bali